Okay. Hi, everyone. Recording this episode in a week where natural gas has just hit really an all-time high for the last couple of years. It's gone up 70% in 1 week, which is one of the largest weekly advances on records going even back to 1990. So about 245 million Americans are currently under storm alerts. Actually, 12% of US gas production has gone offline. And in the UK, Storm Chandra is hitting the UK. So we've seen river levels in River Otter in Devon hit their highest levels ever recorded. Cars are being submerged, and there's lots of issues across the south and southeast in terms of transport links. This just further proves the point that weather really moves markets. We're in a week where the weather has just done all of the explanation for us. So one of the things we want to do in this episode 2, before we even start trading on the weather data, Paolo's actually going to show us just a little bit about quantitative trading, and we're going to look at maybe some examples where weather has driven some price increases. So we'll actually be testing a simple moving average strategy and seeing what we catch. So this is really going to be Trading 101. This is the foundation of the hedge fund that we're going to be building. But then in the next episode, that's when we're going to really start to dig into more detail on the weather signals. So you've probably all been seeing in the last week, if you're watching this episode when it comes out, the Gulf Coast blizzard, which has been happening kind of over the weekend. It's really the biggest storm event that's happened for many years. And actually even down in Florida, in places where they would not normally be experiencing cold weather, they've been seeing the reaches of this storm. So I already said there's hundreds of millions affected. It's happened over about 40 different states. But the really worrying thing is that hundreds of thousands, if not 1 million people, are without power. So there's been a DOE emergency issue, as well as in the UK because of the severe flooding. We've seen some massive amounts of rainfall, 60 to 80 millimeters of rainfall in 12 hours on already saturated ground. So that's an interesting signal there. And I think, what we're going to be diving into a little bit is how some of these things might affect people on an ongoing basis. And the final thing I'll say that happened in the last few days is there was a really good paper called Hot, Dry Spells and Extreme Rain Increasing Corn and Soy Prices in the US Midwest. So one of the key findings there was that actually weather moved corn prices 10%. And this was really due to a mispricing of what were the different combinations of things that actually resulted in those markets pricing that. So it was a combination of rain and heat in the summer, not just heat, and which most models had been previously looking at. So I'm Josh Graham. I'm the founder of EHAB, which is the company behind Weatherwise Studio. And I'll pass over to Paolo to give a little intro.
Must remember to turn the microphone on, right? Okay, so hi, I'm Paolo. I am the head of data science at EHAB, and responsible for building the technical capabilities of our tool. So as Josh talked earlier, of course, we are interested in this series to understand a little bit more about weather impacts on the real economy and on markets. And we are doing this experiment where we are going to simulate trades using our weather signals that we create. But first to start, I think it might be interesting to set up a little context, and we are going to use or just show what kinds of one example of what markets are we interested in and how can we trade on these markets using actual data. So trading, right, Josh, is a very ancient or old activity for the human race. We've been doing it for a long time. So for instance, candlesticks plots that we often see in trading settings, they were invented by Japanese rice traders, I think maybe 500 or 600 years ago. Yeah, that's quite interesting. And when I was an undergrad student, I was interested in that, in trading as well. And I've got this very big book on candlestick analysis, and they mentioned that the rice traders used it. And well, there are many ways, right, in which you can approach a trade. So how do you decide what to buy, what to sell, and more importantly, when to buy it and when to sell it? There are many ways to do it. You can do that based on whatever, even guesses if you want to, or dreams if you would like. Yeah, there are people that do that. We know there are other kinds of analysts that use in-depth analysis. So really human craftsmanship analysis in a sense. So where they, for instance, if we're talking about stocks, they would analyze all the data about the company and do their trading based on insights that they have when reading and going through all this non-structured data, right? So to speak. Right now and here we are more interested in another kind of strategy or a different approach to trading, which we
Quant
call
trading, right?
quant trading, right? Which is where we use structured historical data, numbers on many different variables, and use math and statistics and machine learning to extract patterns from past data and patterns that we hopefully can explore in the future. So it has an important assumption that there are some patterns in the past that will repeat in the future. So if you can extract this from past data, you can just apply it in your current or future trades. So there are many ways to do it. So right now, I would like to share my screen, if that's okay. Let me see.
One thing to add, though, is obviously, Paolo, as we've just seen with some of these extreme weather events, the past is not always purely, 100% predictor of the future. So we have to figure out ways to build in some of these correcting errors given the kind of climate change patterns that we're experiencing.
Yeah, especially with extreme values, right? What the name of that writer, Taleb? Sorry, he wrote up the Black Swan book, and he always insists that these kinds of patterns that repeat, they're just like average patterns, but what might really matter is the extreme events, and we are also going to discuss that because we are going to pick one specific market. So right now I'm just going to show to you guys and use some Python code from an IPython notebook, right? I'm using Cursor here, and Cursor really helps me and is helping everybody build quick things, right? Analytical and whatnot. So what I'm going to do here now is just that I'm going to use one of our own piece of software. I'm not going to use it in the web app right now, but what we're going to do here, just for starters, is I have this market data fetcher, which actually is just a Python library that allows me to retrieve market data from many different assets throughout many different or many exchanges around the world, right? So we can download immediately price data for all these assets. And I am going to right now just 49 in this list here. We are interested. I think the most direct way where we can see the connection between weather data and prices is in the commodities business, right? Because this is something that is obviously quite directly affected by weather and extreme weather conditions. So I'm just listing here a few commodities that we have available in this library. Of course, this can be done with any price or index that you want. But in this example, we are going to pick cocoa futures. And why is that? Because we have seen, so this is where I just download the data. And I did it already in the past. And if we take a quick look at it, we can just see that in 2023 starting in November 2023, there was a really big rally, a jump on future cocoa prices that most media outlets and people from the business believe that this was caused by harsh or bad weather conditions regarding cocoa plants or farms around the world, right? This is quite a very ideal situation for us to start and understand what we are trying to do with Weatherwise Studio. But at first, I just got this data here, and I'm just going to try and take a look at it. Just a quick look. So we have open, high, low, close price data, right? Which is, for instance, if we wanted to draw a candlestick, we could use. We have volume as well. And, what I want to do now is I'm going to use the closing price. Of course, there are many things that we can use, but just to really quickly show what happened around the end of 2023, which is
That's
this
pretty big spike.
a very intense movement on cocoa future prices. And this is what we start by looking how our quant trading strategies, will they be able to pick up on this kinds of movements. So There's a hypothesis in economics that we know is not a really a true hypothesis, but about markets. And the hypothesis essentially says that all information that is relevant for a given price is already in the price. So one way to do quant trading is just by using the historical prices themselves. So in the last episode, I've mentioned a friend of mine that used this kind of moving averages crossing strategy, which is a very old, very known strategy for people in quantitative trading, which just consists in taking a moving average is basically a way of smoothing a historical series, right? So if it has a lot of variability and peaks and lows, it will just smooth them down and calculate kind of a trend in the data. And the idea is if you have a moving average of, say, 10 days, so 10 consecutive prices, and then you move that window on time, this captures quick changes or quicker changes in the price behavior than a longer moving average, say, of 30 or 50 days would capture. So one idea, very common, is to use two different moving averages with different periods. And whenever the shorter one crosses the longer one from below, it means a buy signal. And in the opposite, when the shorter one crosses the longer one from the top, it means a sell signal. And in the meantime, it's just a hold signal. So for quantitative trading, what we would like to do, one very important aspect of it is being able to define trading strategies and backtest these strategies and see how will they perform with past data. So this is what I've done here in this notebook. Again, this is a piece of software that is running behind Weatherwise Studio. But right now we are just using it in the notebook to make it easier to explain. So I'm just going to create, for instance, a moving average crossover strategy. Just an example. I am going to create so this is a trading strategy. So you imagine that at day one, you have a given a value of money, so an initial portfolio in cash, and you are going to start trading. So you have a short moving average. I'm using a 50-day moving average here, and a 200 days moving average for the long term. So whenever the short moving average crosses upwards, the long one, we are going to do we are going to increase our position. When the short moving average crosses downwards, we are going to sell and close our position. And I'm also defining two limits, hard limits of stop gain and stop loss. So whenever we have an accumulated return of 30%, we're just going to close our position and start over. And whenever we reach minus 10% or 10% loss, we again are going to close our position and start over the next day.
And Paolo, a quick question. Would you change the short and the long, moving averages depending on the asset that you're trading? Or is that just a number that you would just pick a number and start to test?
Yeah. Here's just an example, because that is the part that is actually art, so to speak, right? This strategy is very simple, but of course it depends a lot on the lengths of the moving averages. What we're going to do in a few minutes is that we are going to optimize through this and find the best moving average lengths in the past history that work best. And then we will use it. We will do this optimization. We're just going to slice away that period when we see the price really jumping high. We're going to optimize our trading strategy using data up to 2023 before this happened. And then we are going to apply this strategy to this period and see what happens, right? Because this is the setup we are going to mainly be using throughout the series, right? Define a strategy. What kind of strategy do we want to use? In this case, moving average crossing. Optimize this strategy. In this case, it's a simple brute force search optimization, but then we will use other techniques in future episodes to optimize that strategy for historical data, leaving one piece out, right? So then we validate our strategy in this final piece of data and see what would happen. And if we are convinced that we have a really good strategy, then we can apply it now to do our trades, right? This is what we are going to do. But this is just like, I'm just going to create a strategy here. This code will just go through the historical price data and generate a series of trading signals, buy, sell, and hold signals, so that I can simulate this and just actually calculate what would have happened. So in this chart here, we have both moving averages. On red, the longer one, on blue, the shorter one. You see that the shorter one, it moves more rapidly, as we expect. And when we see these crossings, those will be our actions, right? But now see, Josh, by just choosing these two example values of 50 and 200 for the two moving
That
averages,
defines the strategy, right? Completely.
that defines the strategy completely, yes, and it just wouldn't actually have a good result. So this blue line at the bottom, it shows the cumulative return of our strategy.
Not very good.
Very well, yeah. We are going to lose a lot of money if
Excellent.
we just do that, right? And of course, it's a really naive approach. The moving average itself might be considered a naive approach, but using it without any optimization or adjusting for historical data, it's just nonsense, right? You'd be better off just throwing a coin every day and deciding if it goes heads, you buy, if it goes tails, you sell.
Which may not be a bad strategy.
No, sometimes it's usually very often we like to compare our strategies to exactly this baseline. So if you are a monkey doing trades completely randomly on your computer, can we do better than that? Because if you don't, well, and it's important because at some periods of time in some markets, depending on what's happening on the price, it's kind of easy to create a winning strategy. So if you do it at random, you might very well find a good strategy just by doing random trades. So it might be important sometimes to compare with this monkey, crazy monkey strategy, right? Okay, so now at this period, we generated 25 buy signals and 25 sell signals. Of course, this is a simplification as well. We are not considering here the operational costs of doing these trades, right? Which is something that we might be interested in doing in a more realistic setting. But we're just ignoring that for now. And what I'm going to do is I am going to do a slicing, as I said, of the data. And you see that this is data from the 2000 until the 1st of this, October 2023. So you see that this is quite a maybe normal market movement for this asset. We have chopped out the extreme movements that we've seen from 2020, from the end of 2023 onwards, okay? So this is where I am going to optimize this strategy. So I'm just defining the same parameters here, the range. So I'm going to try from 10 days to 100 days for the short range, moving average, from 50 to 300 for the long-term average. Of course, you can increase this grid if you want to. I'm testing each 10 with steps of 10 days. So 10-day moving average, 20, 30, so on and so forth. Because this is a little bit intensive in terms of computation, because it's a brute force direct search. I'm just going to try all the combinations and see which one is best. Okay. This is something if we ever have functioning, viable quantum computing devices, this is going to be the strategy to use all the time, because the brute force search is with a quantum computer is just really super fast. So you don't need to be very smart. Right now with regular computers, it's good if you can be a little bit smarter than this. But in this case, it's not going to take us very long. It's just going to test all of those combinations, and then we're going to see what kinds of results we get from that.
And this is completely without any weather optimization, right, Paolo? This is purely price data that we're using.
Yeah, that's the idea right now. Just to start off by using the simplest of strategies, which assumes that the market is omniscient, so to speak. So it already has factored in all available data in the world, and that's already reflected in the price, right? Which we know is not actually true, right? The idea is then, Josh, that after this exercise, we will start throwing in weather signals, one at first, and using the same strategy, for instance, but instead of using the price, we can use the weather signal, for instance, just one example. But we will start to throw in weather signals and weather data into this and see if we could do better than just moving averages with historical price data. Okay, and these are the optimization results that we have. So these plots here, you can see that each square is a combination of moving average lengths, right? And the color coding is from red, which means losses. Actual, at the end of the period, we would be losing money, and profit, green for profit, right? And we have, as we can see, most strategies are losing, in this case, using moving average, in the training period, right? And we have a few winning strategies, and the best ones are, the best one actually is this one that uses a 10 short moving average of 10 days and a long moving average of 50 days, right? But if we take a closer look here at the final results, we see that it's almost the same result as the second one. With the best strategy in terms of total return, and here we're just using this criterion of which strategy just gave us the best total return. We could use Sharpe ratio, which factors volatility in, right? So uncertainty. We could also take into consideration what's the maximum drawdown during the period. So you're gonna have to be able to face a 27% loss and start and keep trading to actually find or reach that final result of nearly 60%. And the number of trades as well, we might optimize on that. So if we consider everything, we might go with the first one or the second one, or maybe even the third. I don't know. The third, I don't think so. But again, what we want to do now is just get the best strategy, find during the optimization period, and apply it to the latest part that we left, that we chopped out from our training data here. And now we want to apply this strategy to this period with huge price movements and see what we will get. So again, I'm just going to use a piece of code here. This is something that belongs to our software that just helps us doing backtesting, optimizing strategies, and applying it to the validation sample so that we can see what the actual results would be. If we go with a best strategy, which was 10 and 50, we would get a total return of roughly 60% at the end of the period, right? So this is what we've got. If we want to, Josh, we can just see what would happen with the second best strategy, which was 90 and 100 right here. And with this second strategy, second best, we would be we have some good periods here and then, long periods without doing anything, and then doing some bad trades. And at the end of the period, we wouldn't be able to catch this downward trend good enough, and we would end up by losing money at the end, right?
Okay,
so
I see.
the
Yeah.
cumulative return would be negative at the end. So what this shows us is that this kind of strategy, again, it's also very sensitive, and especially in this setup where we trained our model with price data from a normal period, normal trading, business as usual, and then we try to apply our strategy to a period with extreme movements. And this is exactly where the knowledge that we are introducing, that we start to introduce from the next episode on, is really important, because weather data is not price data, right? And if we if we can detect extreme movements in the weather signals, they might signal or might be used to anticipate this kind of strong or extreme movements in the market, in the prices, right? So this, the main goal of this was to just showcase and a small, simple example of how quantitative trading works using this possibly the simplest of strategies, which is moving average crossing. And just to set up how are we going to be working from now on, it's always this is the way to go with quantitative trading, right? You define what kind of data you're going to use, what kinds of models you want to use. You optimize your model using historical data, and you do this back testing, and then you do the validation test, which is, okay, what happens if I was training this model last year and then using this model after that? Would it still be profitable? And we see here that it might not be the case, especially when you have these kinds of regime changes. What we would call here is a regime change in a time series, right? From a normal variation, a normal behavior to an extreme behavior. And this is what we are going to try and discover in the next episodes. How could weather help us anticipate these kinds of movements?
Can you stop sharing your screen, Paolo, for the final bit?
Yeah, it just freezes whenever I stop sharing.
Well, you're still on the screen and I can hear you and see you perfectly.
Really? Because I just can't. The screen is froze for me. I just keep asking me to force quit Google Chrome.
I think for next episode,
Yeah,
download the desktop version. But I'll just close it out and then we can stop the recording.
Yeah, just if you want to, we can redo this or parts of it.
No, I think it's fine. I think it'd be complete fine. I'll just have to chop and change it a little bit. But
just so to ask you just start for free with this Riverside app? Or are you paying?
I think I'll have to invite you maybe as a collaborator or something. But I'll
okay.
Yeah, I'll do that in a sec.
So Josh, what I would really, really like to do, as I told you, apart from having, okay, did you stop recording or how do you want to do this?
2 seconds. So Paolo, what I'm hearing from this is that weather definitely moves markets. We're sitting in a week where extreme weather has shown us that time and time again. Quantitative strategies have been around for a very long time, and clearly even simple ones can make some sort of return. But what we want to start to then do is blend some of these, let's call them traditional quant strategies, with some of our weather focused signals so that we can try to make a better return than what maybe a traditional quant strategy might be. And that's what we're going to be looking at in the next episode. So yeah, thank you so much everyone for being here. Some of the information you saw on the screen was useful. If you have questions, if you have comments, fire them across. And maybe some of you are already looking and have subscribed to our Substack, which is where we're adding even more detail about what we're doing into the newsletter. So some of the graphs and charts that Paolo showed on the screen will be embedded into that newsletter, and you can read it in detail and go through. And again, if you have comments, thoughts, let us know. And if you have another particular, we're looking at Cocoa right now, and this event that everyone obviously knows about in terms of the 2024 price movement. But if you have another big event that you think would be interesting for us to take a look at, then just send it across. We're all ears. So yeah, Paolo, I think we're both in agreement that this is really fun. We're really excited as to what's to come. And thanks everyone for being here.